Good afternoon, everyone, and thank you for joining us today. I'm Sigrid Shalsita. I'm the CEO of Apria, and I'm joining you from our Singapore headquarters. Welcome to our investor series. It's called the Apria Opening New Doors for Investments in Asia Pacific. And today's webinar will be focusing on investing in Japan through Singapore structures. Now, this is an online investor series, specially curated to connect all our international network through insightful presentations on investment opportunities across Asia Pacific. Today, you can look forward to gaining insights on navigating the evolving landscape of the Japanese real estate market, as well as key considerations regarding investment structures, real estate laws and taxes, and operational matters when investing in this sector. The world today is now getting ready for the Tokyo Olympics, which is set to kick off in a couple of weeks, in fact, on July 23rd. And we are all hoping for a very successful and safe Olympics event. Now, before I hand this over, I'd like to thank, of course, our member SAN for putting together this wonderful program. We have an amazing lineup of speakers that we have for this afternoon. So I hope that you get to enjoy and find this webinar very insightful. Now, before we start off, I'd like to introduce our chapter chairman of Apria Japan, Mr. Hideki Yano. He's also the president and CEO of Sumisho Realty Management. I'd like to invite Yano-san, please, to say a few words.
Thank you so much, Sigrid. Good afternoon, everyone. Welcome and thank you for joining us today. I'm Hideki Yano, Japan chapter chairman. I'm joining from Tokyo, Japan. As Sigrid said, the biggest issue here in Tokyo is the Olympic 2020, which is just 2 weeks away. Thanks to the effort to ramp up vaccination rollout, COVID-19 is somehow under control at the level that Tokyo can host Olympic, although no overseas spectator will be allowed and the domestic spectator will be limited. I wish Japan could contain the COVID-19 before Olympic, but the new variant, highly contagious ones, are emerging and spreading quickly, unfortunately. So Olympic need to be carefully managed against COVID. Aside from Olympic, Japan property market is back on track across the board, including the most suffering hospitality and high street retail sector. If you take a look at the J-REIT market, the trading price is back to the level before COVID-19, including a hotel and a retail sector, which have been recovering strongly early this year. You believe or not, distressed type of deals were very few, in spite of a short-term hiccup, I should say, caused by COVID. Japan property market has been proven very resilient and even durable. Along with the foreign tourists coming back to Japan later this year, hopefully, long-term offshore capital continue to chase high-quality core investment opportunity here in Japan. This is one of the mega trends in Asia, obviously, and it will not change in foreseeable future, I hope. Well, let me touch upon today's webinar briefly. Today, Apria and the Sunny Group, a new member of Apria, are hosting jointly. Sunny Group is a global service provider to offer highly integrated and seamless solution about the administration of a cross-border investment structure. Recently, Sunny Group opened a Tokyo office to support cross-border investment to Japan with more localized service to be offered. As you may know, in case of cross-border investment to Japan, Singapore is a key role as a part of investment scheme, which should be structured and managed cost effectively and efficiently within the regulatory frameworks of multiple countries. Therefore, today we focus on the cross-border investment structure through Singapore to Japan, together with a market update. We are extremely fortunate to have such a distinguished speakers, so I guarantee you will find today's webinar informative, insightful, and even inspiring. So with that, please enjoy the webinar. Thank you again for joining us today. I'd like to turn this back over to Sigrid. Thank you.
Thank you very much, Yano-san. And without further ado, I'm pleased to introduce Mr. Mark Bennett, who is the head of San Japan. And I hand this over to you, Mark.
Thanks, Sigrid, and thank you, Yano-san, for the kind words and introduction. So I'd like to take an opportunity to introduce the members of the panel today. I will announce them and they can introduce themselves and give it a little bit of background. So first of all, we have Fujioka-san from GLP.
Hi, everyone. I'm Yosuke Fujioka, head of Fund Management Japan. GLP has been active in developing and operating logistics facilities globally. Currently, we operate 20 billion plus AUM across several private funds and one public J-REIT. Happy to be part of the panel today. Thank you for San and Priya for organizing, and happy to share my thoughts today. Thanks, Mark.
Thanks, Fujioka-san. We have Josh Eisenberg, who's a partner at Morrison Forrester. Josh, would you like to introduce yourself?
Hi, my name is Josh Eisenberg. I'm a partner with Morrison Forrester in the Tokyo office, specialized in real estate and real estate finance. I've been living in Japan for 13 years, focusing on transactional activities in the Japan market. And we work with both foreign sponsors coming into Japan, doing various transactions in real estate through various jurisdictions, as well as Japanese sponsors going out of Japan. And I'm definitely looking forward to this conversation today.
Thanks, Josh. Next, we have Tobias Lindfeldt from EY. Tobias, would you like to introduce yourself?
Yes, thanks, Mark. Tobias Lindfeldt with EY Tokyo. Been in Japan from 1995, quite a long time. And specialty is also inbound Japan, real estate investment structuring, and private equity into Japan. So it's really inbound Japan and cross-border situations like we want to talk about today with Singapore is one of the things that comes on the desk all the time. So very happy to be with you and hope that we have a good discussion. Thank you.
Thanks, Tobias. And last on the panel, we've got Jingjing Chen, who's from San in China. Jingjing? Okay, maybe Jingjing's having a few connection problems. We'll move on. So we've got a series of questions to ask the panel, and we'll sort of rotate the responses through the different questions. Hopefully the questions provoke an interesting and lively discussion, and obviously we would welcome questions from the participants on the call as well. So if you do have a question, please put it on the chat feed, and the team at Apria will help us with those questions coming to the panel. So the first question we had for the panel was, what do you see as having changed in the last 5 years or so that's making Japan a more attractive investment location for asset managers? Fujioka-san, would you like to start?
Yeah, well, thanks, Mark. So I think as everyone's aware on this call, everyone has been involved in some shape or form. Japanese real estate has been one of the favorable destinations globally over the past few years, especially in the midst of COVID. I think Japan has been very, performing very well at not having like a serious lockdown whatsoever with a state of emergency stated as again today. We still have been, managing the situation very well. Yano-san has touched that the J-REIT, the index has priced come back to the pre-COVID situation. So I guess one of the thing is that the real estate in Japan is really opening up its door to multiple opportunities for investors around the world. And what's and I think that's the primary reason that's been one of the favorable destinations of the investors globally, and also people on the ground like asset managers like us. We see a lot of opportunities for real estate transactions. So the liquidity has been improved significantly. If you look at the size of the GRE itself, it's been growing significantly over the last 5 years, and the number of players that you see in the market is, from what I see on the ground, the numbers has been quite a lot, right? And also, I think the last but not least, and most importantly, I think the domestic people previously investing in traditional instruments such as bonds, the government bonds, and also the stocks in general have now shifted significantly to increase alternative real estate assets such as private equity and real estate. So when you see a domestic money coming into the sector, I think it's a good sign that there's, the product provides you a good visibility on stuff. So I understand that this is about the structure from Singapore and Japan, but just wanted to kind of like start off with explaining the environment overall. The real estate environment, investment environment, and managing environment in Japan is very healthy, and I think this trend will continue. And thanks for the low finance cost that the people can still enjoy a very healthy spread across the entire asset sectors, which compared to Europe and US still gives us a good margin over the prime yield. So if you look at those kind of perspective, I think this makes sense. Japan is explains itself as a good destination, supported in the market has just changed dramatically.
Thanks, Fujok. That's very, very insightful. Josh, would you like to go next?
Sure. I think from my perspective, one of the things that's been really interesting has been how much more inviting Japan has become for foreign asset managers and foreign investors. Because I think that even if you look back 20 years ago, if you wanted to buy real estate in Japan, that wasn't really even something that was really possible. I mean, it's really kind of a new thing in the early 2000s, and it grew through the beginning of the 2000s, and kind of. And obviously went through a transition after the global financial crisis, but for the first decade of the 21st century, it was kind of the beginning, I think, of an international story for foreign capital investing in Japan. And then the second decade, I think it's been this kind of growing phenomenon. In the last 5 years, I think it's really accelerated to a point where the ability for foreign investors to come in to source assets, and particularly to source capital. There, I mean, if you would think about it 10 years ago, the likelihood of an offshore, new sponsor, new asset manager in Japan being able to get financing from a mega bank was a much tougher experience. And right now it's kind of, very much open for business for those types of parties who are interested in working in this country. So I think that the way that Japan, has kind of shifted to be more welcoming to capital has been pretty profound. I also think that in some respects that's kind of a change in disposition, but at the same time, the overall environment here has been very stable for over this last decade in particular, definitely over the last 5 years. And when you look at other markets that have been, that have been considered to be really prime opportunities and prime targets for capital, you just see them going through a lot more transition during these periods in various ways, where there's political or financial driven. You've seen, whereas in Japan it has just been a kind of a very reliable place in terms of the regulatory, the legal, financial system. All those things are things that you can look to, and you kind of know what you're getting once you've kind of gone up the learning curve to be able to understand it. And then I think, and importantly, I think there's been new investment opportunities that have arisen in Japan that are beyond traditional real estate, that have been like very welcoming for foreign capital. Things that are classic, investment opportunities for real estate in terms of like retail or office. Oftentimes, they're very competitive for lots of different types of investors, and particularly you're facing a lot of domestic investors. But when you look at newer types of assets, and thinking about things like more infrastructure related, things like solar, things like data centers, where there's not as much domestic expertise. There's a lot of foreign expertise on the development side and the operation side, and there's a need in the market for that type of asset. And you've got foreign investors who are able to come here, be able to use that expertise to be able to develop Japanese teams and access Japanese capital to bring that to bear and do that successfully, which has been really interesting as well.
Thanks, Josh. That's really interesting, particularly around the renewable energies discussion as well, which obviously is gathering a lot of speed and interest in Japan and globally. Tobias, would you like to go next?
Yeah, thanks, Mark. And it's a continuation of what Josh was mentioning on the tax side. If I look at a number of aspects here, sort of Mark's question the last 5 years, purely on the tax legislative side, it's a stability, as Josh was saying. It's sort of, there is no rocking of the boat. There are no huge challenges to tax structuring, and there is sort of a equilibrium established on what tax authorities expect and what the taxpayers give, and that is quite reasonable for both sides, which brings with it sort of the interesting point that should the tax authorities at some point change their mind, which is of course always possible, can happen due to domestic pressure, it can happen in line with international developments. We've seen a little bit of that developing in the last month with, first of all, the change to the US tax laws that the government there wants to make, and also OECD in sort of together with the larger nations trying to make changes. So that could be an influencer on how the tax authorities in Japan will look at things. But for now, it looks like that's very stable, and that has the benefit that we sort of can rely on that. And also it's difficult for the tax authorities to move course or change course, because they would really disturb the entire market if they would challenge sort of these structures that have been established. So that's one thing on the tax side in general. If we then look at sort of real estate, specifically, I think the structures there are especially stable, and of course there are always variations on the theme. So maybe that has to do with what Josh also mentioned, the different classes that are sort of establishing themselves in the market, that each of those have their own peculiarities, and that those need to be addressed from a structuring, transactional structuring perspective. But so the RE, the real estate market structuring is relatively stable. If I look at the private equity side, maybe that's a little bit outside of this discussion, but definitely a market that has much more developed in the last 10 years, whereas real estate goes back a bit longer. As Josh was also mentioning, beginning of the century, end of last century, with a lot of distress that sort of developed and it came into more stable waters. Private equity, because of the supply side, there where Japanese companies are looking differently at their assets and may be more willing to dispose of some assets, which opens opportunities for sort of traditional private equity with, in a sort of slipstream, the real estate side, because those assets that are disposed of traditionally in Japan contain a lot of real estate, and people have that on the balance sheet. So there's a lot of thinking, okay, how can we do something with that real estate? So if you have a private equity firm that buys a business, they may then move some of the real estate that they find in that business to their real estate arm, which is an interesting development. Then maybe on the attractiveness of as an allocation, I think what sort of underscores that is the openness of the authorities. The Tokyo Metropolitan Government has some plan or some theme, which is called Invest Tokyo, making it a global financial city, which it very much was in the 80s and 90s. Then a lot of people left, and then as was mentioned, the recent couple of years have had some instability in other markets. So inevitably, some companies are now looking to come back to Tokyo, and the government really wants to make that more attractive, especially for new asset managers. So If somebody comes to Tokyo as a new asset manager, there are subsidies, there are support. So there are ways for companies to be helped, which is underlining the feel from the government side to make it attractive. And of course, with attractiveness, what is important for attractiveness is stability. And I think because we have that stability, we are in very sound waters there. Finally, maybe, Mark, sorry, I go on a bit long, but last point, REITs was mentioned. J-REITs, a very dynamic market, but also a market where we now, in the last half year, have seen attempts to buy J-REITs and to take them private, which is a new development, which is something that will have focused a lot of investors on that opportunity, and sort of we're trying to find ways to structure that sort of transactions, which is the next step in that specific area. Back to you, Mark.
Thanks, Tobias. It's extraordinarily helpful, and I think the themes coming out from the group here are sort of around stability and obviously the ability to invest on a stable basis. Unfortunately, I think Jingjing's having a few technical problems, so we may not be able to hear from her just yet. Hopefully we can solve that and maybe come back to Jingjing to get her thoughts in as those technical issues resolve. So the next point, maybe just to ask the panel's views on, from your own perspectives, what do you see as the main aspects to consider when you're developing a joint Singapore and Japan structure? Perhaps we can hear from Fujioka-san again.
So we quite often use Singapore related structures in our investments, and what we see from our perspective is basically the stability, the track record of having those in place, and we've been doing for a long time. So it's nothing new to us, and I think we have the tax treaty between the two countries have been solid. I think that the points that have been covered by the gentleman here. So I think we all agree on that side. And for what investors are looking for is also the stability as well, right? And I think that's one of the key is basically how kind of comfort that we can provide from a tax perspective, where all the revenues has been generated onshore can be correctly, rightfully been distributed out to the countries wherever they are invested from. So I think it is important from us that to minimize the tax burden is obviously what we want to achieve, but I think equally important is that how much that the structure has integrity, and how comfortable the people from various parts of the world can come to Japan for their investment destination. And I think Singapore is one of the ideal places that we see that can provide those certainties to investors. So those are the points that we make sure before we kind of like launch a new product in front of investors.
Great, thanks, Vijay. That's incredibly helpful to get your perspective on it. Maybe Tobias, could we hear from you next?
You're catching me by surprise here, sort of a variation. So on the tech side, what is interesting, I think, between Singapore and Japan is that the countries are actually aligned, because what is required to benefit in Singapore from 13X and 13R is really what the Japanese tax authorities require from the Singapore holding company. So if we think of a structure where Singapore owns Japan, I will not go into all specific details, but I mean, at the end of the day, it's a share ownership by a Singapore company in a Japanese special purpose company in many cases, and so a dividend comes up, and that for that dividend to be eligible for the treaty rate of 5%, required is that there is proper substance in Singapore and proper business purpose to have that structure in place and to start with. And because of the rules in Singapore, that is something that is almost guaranteed, because that's the way the Singapore authorities want the structure to be set up. the one thing where there could be some discrepancy is the amount of people in the entities in Singapore, whether it's a service provider that provides the substance, or whether the asset manager in Singapore itself provides that. I mean, there could be a transitionary period in there that you start with a third-party provider, but at some point in time, you need to build your own substance. So, which is good for Singapore because the country then gets people that work in this added value world in the asset management side, and are involved in the outbound investments into Japan. And again, that is mirrored by the requirements on the Japan side. Now, that is for real estate, which is, as was mentioned by Fujioka-san, the treaty is good for real estate. The treaty is not specifically good for private equity because real estate structures with Japan rely on this liquidating assets concept. So we sell the asset out of the Japanese special purpose company, distribute a dividend, and be eligible for the low tax rate. But if the strategy is private equity, we want to sell the shares in the Japanese business, and we want to make that sale without capital gains tax. That unfortunately is not covered by the treaty with Singapore. So that would be, if there's one thing where that could be improved in treaty discussions, if we go forward and you say, okay, what's on the wish list, that would be extremely helpful, because then asset managers could more align the various strategies in one location. Whereas now you see capital gains tax strategies more played out in Hong Kong, and real estate you see actually moving a lot to Singapore. So I think improvements can be made, but require maybe some discussion at the government level to change that treaty, which is good, but can be better.
Thanks, Tobias. It's really helpful. Josh, please.
Yeah, so I think that when I'm thinking about these things, when the client comes to me, one of the key elements is clearly risk. You know, how stable is the structure going to be? Could it be attacked and invalidated such that whatever the benefits you're trying to get from them could be, could be lost over the course of the investment period. And I think that, as Fujioka-san mentioned, that it's a very stable structure. It's been in place. You've got a lot of capital that's come in, which creates its own inertia and its own kind of strength of support for what that means. And additionally, another big piece that I could need to grapple with is logistics. Because when we're trying to manage an investment in Japan that's coming from Singapore, you've got two legal jurisdictions that you have to manage with with its own. Each has its own set of requirements, regulatory, legal, as well as financial, oftentimes. And then oftentimes the way that the structure is set up to work from a Japan perspective, sometimes you may need a third jurisdiction in place. In order to kind of check all the boxes that you need to check. So when you start thinking about that, you've got at least two, maybe three jurisdictions. You're thinking about financing that's got to come in. So that means that you have to have legal advisors engaged in at least two jurisdictions. Who's going to manage that process? Who's going to make sure that, and oftentimes, given certain, professionals want to stay in their lane and they want to focus on their expertise, but someone's got to have the complete picture of the entire system, and oftentimes that falls on our team. And so you have to be able to be smart, experienced enough and knowledgeable enough to be able to know what you need to know, as well as what you don't know, in order to ask the right questions, and coordinating all that and making all that work across time zones, across jurisdictions, usually on tight timelines, is that's always that's kind of a big part of what I grapple with. And then finally, there's the compliance piece. When you're particularly when you're talking about Singapore and Japan, they're both very developed countries, very developed legal systems, very, focused on, making sure that people do business correctly, do business in accordance with all, the standards that are kind of exist and which are heightening oftentimes, particularly as it relates to things like money laundering, and general compliance, and so then on top of that, the structures in Japan often they have their own level of requirements around securities law, around tax, and specific legal regimes, which all you need to make sure that all these things are working together within the jurisdiction as well as with the other jurisdictions. So the pieces of making sure that the compliance elements work, making sure the client's familiar with them, making sure that the other advisors are familiar with them and able to kind of meet those expectations on timeline, at speed, are all things that oftentimes that we have to kind of be very much involved with in terms of coordinating as well as communicating.
Great, thanks, Josh. That's really helpful. Just looking at the chat feed, we've got a question which I think is kind of a link to some of the conversations we've been having. So it's from John Yip. Thank you for sending the question. So just to read it for the benefit of everybody, the question is: in the case of a TMK or a TK holding structure, is there any advantage of Singapore over Cayman or BVI for real estate transactions of the TBI? Does anyone have a view?
Well, we usually charge for those questions, so we should be a bit careful. But
is there something you can give us for free, Tobias?
The point here is a treaty, right? So there's domestic rates. I mean, this is purely from a tax perspective. There will be definitely a legal angle here, but from a tax perspective, the treaty, so domestic rate says something, and sometimes the domestic rate is influenced by the treaty. So when you mention TK, there are very few treaties that influence the TK rate, the rate on profit allocations in a TK situation. So there's almost no difference between the allocation of TK profits to somebody in Singapore, somebody in Hong Kong, somebody in Cayman, somebody in Bermuda, in the US. It doesn't matter on the Japan side. It matters to a few countries, like Korea, for example. If the investor is in Korea, then there is a too good to be true a treaty, and that allocation is subject to zero withholding tax in Japan. So on the TK side, that is relatively easy. On the TMK side, definitely treaties make a difference. So when you mention Cayman, there's no treaty with Cayman and Japan, so there will be the domestic rate of withholding tax 20 point something %. Whereas the treaty with Singapore gives you 5%, that's 15% in the pocket. So that's a big difference, right? So that really makes a huge difference. So generally, we like to use treaties, but for this peculiar animal that we have in Japan, the TK treaties in most cases don't make much of a difference. And maybe I wanted to add something to what Josh was saying. When we deal with specifics on Japan, TK is one of those specifics. And maybe adding to what Josh was mentioning, maybe he wants to say more to that, is managing the understanding of it, especially foreigners like US or Europeans, on what is a TK is a very difficult proposition, because it's something, although it comes from German law, it's very specific currently in Japan, and it's not very easily understood. And so it takes a lot of time when we provide the service to explain that, particularly to newcomers to Japan, what is required to make it work. Maybe Josh, you have your experiences there as well.
Yeah, I think that the question is not so much about TK versus TMK. I will say that TMK, between the two structures, this is my basic statement would be, a TMK is much more, I guess, like, what you get as long as you do everything that you need to do to set it up correctly. Insofar as that, it's very much very clear in terms of how you invest in it and what the benefits are going to be. In a TK-GK structure, the challenge you have there is that it's actually much more simple to set up in terms of how you structure it, but there's a lot of nuance to it in order to have certainty that the structure is going to will withstand scrutiny if, you know, in the event that it is scrutinized. And so there's a bit more give and take in relation to, you know, how much tax leakage you're willing to suffer in a TK that in a TK-GK structure that is kind of a much more of an art in some respects than a science, whereas a TMK is very much like clear cut. You know what you're doing, and you know what you're going to basically get out of that. And that's kind of the short spiel on how those work. As between those jurisdictions, my own bias is generally that if you're completely agnostic and you don't have a treaty, Cayman's probably the easiest one because it's got the most flexible entities to work with. Amongst those choices between Singapore, BVI, and Cayman, the trade-offs, you do have trade-offs there between, you know, between ease of setting up, what sort of, you know, resources you need to set up, what sort of resources you have on the ground, as well as whatever sort of, you know, internal or external, you know, image issues you might have in terms of concerns about what that jurisdiction means when you go to your investors and using that.
Thanks, Josh. Thanks, Tobias. Hopefully, John, that was helpful for the panelists, and free advice is good advice, I guess. So thank you. So if there is no further questions on that, maybe we can move on to the next topic, which was from your own perspectives, what do you see as the future for these Singapore and Japan structures? Fujioka-san, if you wouldn't mind.
Well, I think these answers are more for Josh and Tobias. I guess the only thing that I can say from our sake is just be stable, and so that we can be, you know, benefiting from the structures and investors can enjoy. And I think, you know, coming in, the offshore money coming to Japan is very important for the industrial overall. So I think, you know, we just want to make sure that its stability stays in place. So it's more like the comment that I also want to hear from Tobias and Josh about this as well.
Thank you. So on that basis, Tobias, would you mind giving your thoughts?
No, not at all. The first thing I would say is, as I mentioned earlier, the changes that could come are probably external influences on the tax side again, right? External influences that drive governments to make changes to the way they want to tax certain things that have been dealt with in a specific way for a long time. And yeah, you would say, why would they do that? Well, that could happen. First of all governments need a lot of money, especially after the last year. So that could be one way to incentivize governments to look again at what they're doing. Another way could be domestic pressure. It's always easier to tax foreigners than to tax local. So that's another one that could intensify. And then the third one is just changes to the international tax landscape, where Japan, and that's an important thing. I think that's sort of often a misunderstanding or lost in translation between Japan and Western countries, where Japan really looks in the tax side to the form, still more to the form than to the substance, which is amazing. You would say, hey, you would really look at the substance because that's a global trend. Western, US, Europe, most countries will really look at what's the substance, what's the intent. But Japan still very much looks at the form, and the reason for that, to be honest, I don't really know. I think it's developing, and chances are, in my view, that will develop further. It may be because of language issues or understanding of foreign systems, but I think that the tax authorities here really are smart, and they know how international tax systems work, how other countries' tax systems work. They study that, so they really know what's going on. But I think Fujioka mentioned that they also don't want to rock the boat, so they're sort of happy with the status quo that we have now. And I think, go back to what I said right at the first question, If that position continues, which is really good for everybody, but the question is if these external influences, the 3 points I mentioned, they may disturb that, and if that happens, then it's a reset, and it can be a significant reset, because, for example, we talked about the TK. If the rules around TK would be changed, that would automatically mean a significant reset of the effective tax rate in Japan. If the rules on treaties would be reset on the withholding tax because the substance requirements or the intent in the holding country company would be different, that would also have a significant influence. And I'll go back to what I said on the private equity side. There is much more uncertainty at the moment, which we're still working through in actual transactional situations to see how those often partnerships that acquire Japanese shares, how they should be looked at. And if we look through those partnerships and require filings from LPs in treaty countries, or filings from blocker entities that block the investment up the chain. So I mean, that's an area where we're still working through, and where the tax authorities haven't really, I think, definitively, for the time being at least, expressed the way they want to proceed. So in that sense, it's still a work in progress.
Thanks, Tobias. Joshua.
I think those exogenous factors, are important to kind of keep in mind in terms of what could possibly happen. But I really can't speculate as to like how it could change. This is one of those things in these areas where it's been very stable for a long time, and I guess this kind of goes to a point that I was thinking about that we maybe talk about later, but is that there's kind of a good relationship between the availability of the benefit and the extent of the investment in terms of like the cost of the investment to make it work. And what I mean by that is that it's not like you can just easily take advantage of this tax treaty to set up and between Singapore and Japan, and just do that all day and just run capital through that. There requires an immense commitment in really both places for the structure to work. In terms of the substance requirements of Singapore, as well as in order to make the Singapore element work, there's a lot of upfront cost and ongoing cost and considerations about having people on the ground on a long-term basis that you have to have. And in Japan, obviously, in order to do things in this market here, you really have to have a commitment to the market in terms of your ability to be realistic and credible. And so I think that to me, it feels like there's a lot more strength, and I would say resilience, likely, at least in my mind, resilience to what it looks like going forward. And based on that, I would expect that there would be a continued growth in the use of the structure. What I often see with our clients is that particularly when they're coming to Japan or they're coming to Asia, oftentimes I work with a lot of American private equity groups and American sponsored asset managers. They want to use Singapore as the hub because of the natural geographic location in terms of Asia coverage, but also the benefit of Japan. And oftentimes they'll be doing their first deal in Japan before they even get Singapore set up, with the idea of getting Singapore going. And this is kind of like but the long-term expectation is that Singapore is going to really be, going to be an important element to their overall Asia strategy. And, this is something that we've seen with newer asset managers coming back to Japan. And I would expect that we'd see more of it going forward.
Thanks, Josh. That's really helpful. We've got a few questions coming through, but we've also got a couple of questions to ask. Maybe there's one that Fujioka-san has more of a view on. I think we're slightly running out of time, so maybe we'll just take one more question to the panel and then try and clear up the chat feed. So it seems that the last question would be, it seems that the Japanese real estate market is doing well at the moment. As we've discussed, transaction volumes are reasonable. And I think Janos-san's opening remarks commented on that. You know, what are the areas of concern that the panel have as to whether this is a sustainable development, particularly on the market side? And are there any indicators that we're entering another type of bubble, a la the 1980s? Fujioka-san, would you have any views on that?
Yeah, I think the biggest difference that we had in the past and now we don't see it today is the amount of debt that's been poured into each project. For instance, no one is gearing up to significantly high level, and people are very cautious about what kind of financing that they're going to achieve for each investment, and all the capital investors that are wanting to invest in Japan is not looking for high leveraged the vehicle at this moment, and I think what people are looking for in Japan is basically the stability, right? People are not coming here for the highest risk globally. Basically, it's one of the lowest risk if you turn into real estate, because there's basically the construction risk is minimal, the development risk is minimal. I think what Josh said, it has to be local. So you have to be in this country and you have to know these people to get the business. But if you have the access, I think the risk of conducting the investments are very limited compared to the other even developed countries. So in that case, I think the main strategy for people to allocate their capital to Japan is to look for stability and continuation of that stabilization. So again, that kind of like drives the decision, okay, let's make sure that the leverage has been kept very healthy so that we can get a good distribution from the investments, but not like chasing crazy yields on the capital gains at the very end. So I think a lesson learned, and when the bubble in the 90s and GFC, I think people went twice in the last 3 years, and we know that there will be some time that the music might stop. But I think from what we see on the ground, people are very careful about it. So again, I don't say never, and personally, I don't think it. I won't believe that it should come. I don't want that to happen. But again, I think people are taking measures in order to make sure that they are bracing for the impact that might happen. So I think it's a long way to say. We strongly see that this thing will continue with a little market risk in Japan.
Thanks for Jokson. That's hopefully comforting to know. Josh, would you have any views?
I basically agree. I mean, I feel like there's a lot of, it's been the story very much is about stability. It doesn't feel like a real high risk, like high velocity environment. When in our view, kind of the deals that we're seeing, the leverage levels are not very, the banks aren't willing to go that high, even if, the sponsors oftentimes will take whatever they can get. But, I think that there's kind of a reasonable sense of keeping things a bit restrained. And lending terms, banks are definitely not like giving away money for free. I'll say this. They're not giving away money easily under easy terms. They definitely, it is cheap, but it still requires you to jump through a lot of hoops to have very robust compliance and to be, really confident that you can meet a lot of very, stiff terms and conditions that banks are just not willing to give up. And so it's not like anyone can come in here and get a loan and buy money and buy property and expect that they get all the upside and then like walk away from it and it dies. There's really, I think there's a lot of deliberation and sense of confirmation of who the counterparties are in order to be able to transact. As I mentioned before, there's a lot more willingness to deal with foreign parties, but there's still, I think, a high hurdle that you need to meet in order to have credibility, in order to be able to get access to those things. And finally, I think that one of the points that was made earlier is that I think that the experience through the last 18 months through the pandemic, which, you know, at the beginning was looking like it was going to be a massive, you know, distress event for everybody when, you know, across the market in retail, in hospitality, you know, and even in office where, you know, all of a sudden you had hundreds of loans across the market that were, you know, that were non-performing or poorly performing. And you just didn't see financial institutions take aggressive action. And I think that, you know, that I think there's this, that works on both. I think that they knew that if everyone went for it at the same time, that caused a systematic, that caused a systematic problem. But I also have a sense that there isn't a sense of the risk being there that forced that behavior. And so I think that speaks to the environment in terms of, you know, it not being so brittle as to trigger, you know, a sense of like imminent risk. I mean, again, I am definitely not a prognosticator, but just based on the facts that you see it, as I see it on the ground, it doesn't feel as though, you know, that this is something there's like a pending storm in front of us. Knock on wood.
Thank you, Josh. Tobias, would you like to finish those thoughts?
Well, there's not much more to add. I think the only thing maybe what I could say is that because of the diversification of assets classes, there's so many more asset classes than probably there were in the 90s. And when there were no foreigners almost, I mean, most of the problems of the bubble were domestic, right? And so now you have you have more responsible banks, you have lenders with a different profile, borrowers with a different profile, and you have more asset classes that sort of work as a sort of natural hedge. I mean, sort of solar was very popular, and then there's something happening with the tax laws. It's a little bit less popular, and then data centers are the flavor of the month. So it's moving up and down, which I think also helps. And J-REITs weren't there 20 years ago. I mean, they just started about 20 years ago. So yeah, the market is very different, and I think that helps as protect the situation, it seems.
Thanks, Josh. I'm just very conscious of time. We've got a couple of questions to answer. They feel quite substantive, but maybe we can try and get through them quickly. Sigrid, is that okay, or do you need the time back?
No, go ahead, Mark. It's okay.
Thank you very much. I guess people will drop off as they need to, so if we do run over, I apologize. So this is a question from Neil Blondell. Hong Kong can be fairly similar to the benefits of Singapore, or is there a particular structuring advantage that it is Singapore specific? I guess that's probably one for the lawyers and the tax advisors. Tobias or Josh, would you have a view?
Well, I mean, Tobias is going to say it much more eloquently than me, but it really comes down to the treaty. The treaty, the Singapore-Japan tax treaty gives a particular benefit to investing in shares that you don't have with Hong Kong, and therefore you're able to, if you're able to get a much more favorable, withholding rate on your dividends from Japan to Singapore than you are from Japan to Hong Kong when you invest in shares of a company that owns a real estate asset.
Maybe to add to that, this is what I mentioned earlier, the difference between private equity and real estate, a traditional private equity. So real estate, much better for the Singapore Treaty, 5% withholding tax as opposed to 10 for Hong Kong. But Hong Kong, on private equity, disposing of shares, there is a potential for capital gains tax exemption. So it's a different strategy for different assets. So I think both countries have an edge in specific areas.
And I guess just to show what follow up, the one reason, and the reason why the share transfer strategy doesn't work for real estate is because it's maybe just a market practice, but you really can't transfer finance, like a company subject to financing in this market. It's not really, that debt is not transferable. The expectation is that real estate is going to be, real estate acquisitions are going to be asset transactions. And so there's not really a viable exit in a real estate investment that's going to be an entity transaction. So the expectation is that it's almost always going to be an asset transaction, and therefore you're going to be getting your returns as dividends as opposed to transferring shares.
I need to add one thing, because just to avoid problems there. So when I talk about capital gains, I talk about private equity capital gains, non-real estate, because there is something in Japan which is called the real estate holding company. So if we transfer shares from overseas in a Japanese company that has more than 50% of its assets as real estate, then it's very difficult to avoid capital gains tax in Japan. But as per Josh, that's not the strategy. The strategy is a liquidating strategy where we sell the assets out of the SPC and distribute the gains as a dividend. So, but it's important to keep it in.
Thanks, Josh. Thanks, Tobias. Just one last question. We have only a minute or two left, so and apologies, this is a very large question. So if it can be done quickly, great. If not, we'll maybe have to hand over to Zander to give you all the time back. But the question came in from Alvaro. How will the current G7 efforts to institute a minimum 15% corporate tax affect the current structures taking advantage of the Singapore-Japan double tax treaty? Tobias, if this is not you, I don't know who it is.
Yeah, I don't know how Alvaro, I don't know if this is already clear to everybody, but I mean, this whole tax law change is focused on a limited segment of companies, namely the high-tech companies, and because of the way they structured, they managed to avoid paying tax in the country where their customers were, because they had very smart ways of setting up their structures, and that is tackled here. And the reason why the governments have worked together to address that is that otherwise countries will go at it alone, and you get a hodgepodge of rules. The UK introducing laws, France introducing laws, which is not very helpful for taxpayers. So I think that is very specific, and you've seen, for example, the City of London already has managed to get an exception for this 15%. So how that works, how that's going to work in this segment, I don't think it will hit it, because we're paying tax. We're paying tax in Japan. We're paying tax, withholding taxes. So I don't think that would specifically burden this type of transactions, as far as I can see it.
Thanks, Tobias. Also, thank you. I mean, that was the end of the panel session. We ran over a little bit. Apologies to those people that were hanging on. So with that, I thank Josh, Fujioka-san, and Tobias for their participation. I apologize for the non-participation of Jingjing. We seem to have had some technical problems, but I guess these things happen. So hopefully the next session we can hear from Jingjing. So with that, I will hand it over to Zander to give the closing remarks.
Thank you, Mark. And once again, many thanks to the panelists for bringing us through such an insightful discussion. I'm Zander, and I head up business development in Singapore. Our fundamental motivation to have this webinar stemmed from the increasing volume of conversations we are having on investing into Japanese real estate, and specifically from my end here in Singapore, how to do so using Singapore structures. Our speakers have clearly articulated the resilience and stability of the real estate market in Japan, and the promise the asset class holds when the pandemic is brought under control and economic recovery commences in earnest. COVID-19 has spurred several developments in the country, with two major ones being the broadening of the investment market, with buyers looking beyond just Tokyo nowadays, and the maturing of the market as a whole, giving rise to popular sectors such as logistics, data centers, and renewables, as we've heard. This definitely presents continued upside potential for investors. The panel discussion also alluded to the fact that purchasing and managing property in Japan, or in any foreign country for that matter, can be quite complex. At times, it may even be compounded by language and cultural differences. Having a team of partner firms, especially those with presence across your base country, as well as investment locations, will help preserve investment returns and perhaps even your sanity. Lastly, being a part of relevant associations such as APRIA could also be beneficial, as tapping into their network of members and knowledge resources might be able to help smoothen your investment journey. Once again, thank you to all the speakers for your thoughts, and to APRIA for making this webinar possible. And to the audience, we really appreciate your interest and participation in today's webinar. I'm Zen again from San, and on behalf of my firm, we wish you good health and stay safe. Have a great day ahead.